Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, it's Paul Tyler, and welcome to not just another episode of That Annuity Show, but our 100th episode. Mark, how are you?
I'm doing great, Paul. Hard to believe we're at the 100th episode already.
Unbelievable. Ramsey, when you came on as a guest host, did you ever think we'd be doing 100 of these?
I had no idea, but I have to say I am just really psyched to be part of the Century Club now. This has been an amazing ride.
Really have. And we've had some great guests along the way, and so we thought it was only fitting to have ask Joe Jordan to give us some of his wisdom again. One of our first, Joe, I think you're actually the first repeat visitor. For those of you who are in this business and in a corner, I'll just give you a little bit of a bio here. Joe is an inspirational speaker. He's a behavioral finance expert. Joe, you actually wrote a book, Living a Life of Significance. Okay, and that came out, I know it was a few years ago, but I still see people talking and writing about that.
Right.
You ran insurance sales at Payne Weber. You were a senior vice president of MetLife, and where I met you, and you practically ran that place for a number of years, especially on the retail side. Mm-hmm. And you're also, founder of the Insured Retirement Institute, and some of those people in the business who've been around a little while used to know that as NAVIS. So, Joe, what else did I miss in what you're doing and where you're headed here?
No, that pretty much covers it. I mean, I think I had a very diverse background in financial services. People tend to stay at one or the other, but back then it was more isolated. Stockbrokers did what stockbrokers did, bankers did what banks did, and insurance people did that, and so that was starting to come together. But it started to come together at a time when people were just looking to diversify revenue streams. Hutton at the time was the big one that was becoming successful with insurance. But what's happening now is it's all converging, because what I think is happening now is, and this has been happening since I've been in the business, so I've been able to watch it and go, it's really being driven by consumers. It's not being driven by the regulators. People want to deal with one person and have multiple things taken care of at the same time. And so people have to have multiple disciplines, or they don't necessarily have to have it. They better be part of an organization that does it. And people aren't interested in just getting a product. They're looking for a plan. And they need a partner in the plan, and that's what that person does. So that's really what's really happening now today. And that's why I'm pleased to do that. So before, you used to have, you still have product experts, if you would, but that's something that I thought was going to happen, and it appears to be happening now. I'm very optimistic about it.
So, Joe, I guess what are some of the biggest challenges that you've come across? And I know in the past you've worked with converting typical investment brokers over to selling insurance products, and then also converting insurance brokers over to selling investment products. What are some of the biggest hurdles that people have when making that adoption over to the other side?
Well, at the time, and this is in the 80s, man, so it was different, One of the things I learned was, and you were talking to a wirehouse in the 80s, you want to sell insurance. What are you kidding? They put up a crucifix and wear garlic, It really, most of that is behavioral change, and it's behavioral change. And it's got less to do with money and process. It's the way people viewed themselves and what they did. And so the point was, first it was product oriented, but now the change is it's becoming more client centric oriented. It was the first steps in terms of doing that. And I think the client's been driving it all along. So, stockbrokers sold greed, and they went after assets. And then an insurance business sold fear, and they went after income. So a fundamental shift. I don't think I told you this, Paul. When I first got to Met, because I was a life agent, I understood them. They would always import someone from Merrill Lynch or what have you. Life insurance people were never asset gatherers. They didn't ask people for $100,000 a year. They were asking for $100,000 at one shot. They were asking them for $300 a month or $1,000 a month or something like that. So you had to fundamentally understand that. You had to begin to alter and make them feel comfortable with doing something different. And annuities was a great thing on both sides, both getting investment people to do insurance and for insurance people to do investments, because it trained the insurance person in the idea of asking. You just go, people have a CD in a bank. One of the things that really marveled, this is 1988 when I first got to Met, I asked them, I said, what do you think is the number one asset that the Paine-Webber client base owns, the one asset that most of them have? And everyone was guessing, stocks. It was passport savings accounts. Okay, so of course those are the few, but they wouldn't believe it. They couldn't. So I was trying to bridge the gap in a way they could understand. And then I would do stuff at Met to say, here's the tower, the MetLife tower. I had the model. Here's a tower. Then I had a little model of a bank, and so instead of putting the money in the bank, so I put the money in the bank. I put the money in the tower. And so that's how it went. So and then the other issue that popped up was on the compensation side. So these are just some of the cultural things. So this was back then, and I'll digress it up to what have you. Is, everyone's saying, well, why should I work for 4% when I can get 50%? When the 4% is more than the 50%, So it was like, it's things like you wouldn't imagine would be the case unless you were imbued in the culture and you understood it. So I think those were some of the things that happened. And so what it did, it broadened the horizons because take a look at MetLife, right? They sold all this insurance. Someone dies, they give them the check, and they walk away. Okay, so they had no capability in terms of some form of follow-up or what have you. So, it went from annuities, and that's where we were able to get them into mutual funds and all the other stuff there. And there's an interesting story with that. I think Paul knows this. When you're changing culture, you have to be very particular about it. One of the things that happened is people at Met begrudgingly told me, okay, well, you got them selling fixed annuities, but you'll never get them to sell a variable annuity. Our guys can't do it. This is senior management, our guys, So, it was more the image that the senior management had of itself than the reps, So that was the thing that I came up with. I had a fixed annuity, and then the first variable annuity, all we had was one fund. It was the S&P 500 fund. Why? Because God wanted it. Okay. And by the way, what I had to tell people was, you know what? The people at Merrill Lynch, all those other places, they have 100 mutual funds. They sell like 2. And they don't even know the difference. So the reason I picked the S&P was, first of all, it managed to expectations. It does what the newspaper does. The market goes up, it goes up. The market goes down, it goes down. Because I learned this lesson at Paine-Webber. We had this thing called aggressive growth, right? And so if the Dow goes up by 10 points, what do you think aggressive growth should do?
Should go way up.
Yeah, go down 9. So how do you explain that? You can't manage expectations. So I knew that. So we did something very simple at Met. We just did a thing. What does a first-time risk taker and a first-time risk seller really worried about? They're really losing their principal. So we did this thing, the equity generator. We put the money in the fixed account. And we just put the interest in an S&P 500 fund. It's the early 90s. Who the hell, interest rates started to go down. Stock market went up. So when you buy a CD player, they're CD buyer. They're looking at every basis point. So just even the small dollar amounts that were going in was really beginning to build up in terms of from a basis point perspective. So it meant that. So it got people started. That was the whole thing about a automated investment strategy. That was working there. And then on the Paine-Webber side, you just had to use things that people would understand. You have to use the same terminology. This is a AAA rate, a AAA credit with with a triple C coupon, that type of stuff. So you had to get that started. But what that did, that was the way of starting to get people to become multidisciplined and selling about other products, beginning to change the way they perceive themselves. And I had a sense that it was going towards the planning thing. I mean, that's ultimately where I think it went. As I look back on it, that's why I talk about that in my book, Living a Life of Significance. Because my main goal, what I wanted to do, was I think the investment culture or the financial services culture is really not as client-centric as others are, and that's the penalties we paid for that. That's where the DOL came from. Most people think we're a bunch of humps, and we don't do much to dissuade that. So my whole emphasis is about the impact that we have, and I'll just I'll go further. I mean, I think the major issue the planet faces isn't global warming, and it isn't the disease. It's the aging population of the world, for Christ's sake. Okay, by 2050 there'll be 2 billion people on the planet over age 60. Okay, Japan will lose 18% of its population by 2050. It loses half its population by the end of the century. We have a lot of people living a hell of a lot longer. All of the programs that we had before, if you retired at 65 and you were dead at 68, who cared? Now you're living to 90. And you know what? There's no matter what the government says they can't take care of it. No matter what a company says, they can't take care of it, okay? It's yo-yo. You're on your own. And the fact of the matter is that's what we do. That's what we do. We give people the ability to have dignity when they reach retirement. And we don't talk enough about that. So I really think that's the thing in terms of the culture, which, you should praise people for doing it, and they show up and you put them on stage and you do all of this other stuff and people make a lot of money. But I think the thing that really motivates people to do the right thing is to understand that you do the right thing. And that's really the essence behind living a life of significance, because you do. Because, if something really bad happens to someone, and what I'm trying to talk about is a balance of it. What happened at Met is we got them so much into investments that they started to lose the other culture, and so, of course, no one wants to be the insurance guy, and then all of the other stuff, people have to go and take a tinkle in a cup and, all of the things that are associated with it. Well, now with technology and moving in the large, big number, it's making it easier. But my point is this, and this is on both sides now, because I speak to financial planners and I speak to insurance people, and I'm even starting to talk a lot to the people who just specialize in Medicare supplement stuff and Medicare Advantage. You all got to learn all of the stuff because it's all interconnected. And that's really what the customer's looking for. And that force will never stop until we adapt that way. And so that's the integral part that I think these products play. The other thing that I think is crucial, especially to get across to investment-oriented people, is everyone's always looking for the non-correlated asset. That's why you put money in bonds, because the stock market goes up, the bonds, enough spaghetti hits the fan, everything goes down. But that ain't true when you have mortality credits. That ain't true if someone dies prematurely. That ain't true if you're 78 years of age and you put money in a fixed annuity, and most of it's being driven by mortality credits. So it's a very powerful thing. It's the only program, it's the only financial product that deals with humanity in terms of living and uses that other trigger. And it's very difficult for investment people to comprehend and to understand that.
Yeah, so a lot there, Joe.
I'm sorry, I get carried away.
Yeah, no. Okay, some numbers have stuck out in my head. 2 billion people over 65, right?
Over 60 in the planet.
Over 60. Japan shrinking by 18%. We're coming out of this, at least it feels like we're waking up from this pandemic. How is this changing behavior of consumers and how they think about these products? The market went crazy, right? Everybody thought the market was going down, and it didn't. It went up.
Actually, when you think about it, on March 23rd, that's when it was, March 23rd, 2020, the market went down 34% in 33 days. It's unprecedented. You know what happened the next 50 days? It went up higher than it ever has before. So how the hell do you expect civilians to be able to react to that? So that's the thing. And so I think the other thing too that's important, remember I talked about behavior of producers. The way consumers or the way investors behave has more relevance than to the investments that they're in, to the fees that they pay, and whatever performance they have. Because consumer behavior is the primary determinant in terms of whether or not people succeed or fail. And what's good about insurance products, specifically annuity products, and to some extent now life products, is there are some safeguards that are in there. So people, I don't know, did you see, maybe I'm jumping ahead, but Dalbar just came out with a study where people were crucifying variable annuities because the expenses were too high, and that's where it is. And so who is it? It's Susie Orman and the other two guys, I can't remember their names off the top of my head. The guy who does all the ads in the newspaper.
Oh, Ken Fisher.
Ken Fisher, yeah. He does it all the time. So, but Dalbar came out and said, you know what? Investors in the separate accounts and variable annuities perform better than people who normally put money into managed money. And that has nothing to do with the fee structure. It happens to deal with people left to their own just panic out. Or they have an advisor who doesn't really do their job, telling them to stay put, because that's the point. A well-timed intervention's worth a decade's worth of fees. So they always harp on fees. Why? Because it's math and it's easy to write a book that people buy. That's how they make their money. But fundamentally, the idea, I think, of the person that's in financial services is the idea to be giving consumers the right type of advice at the right time. They need to be invested in equities, okay? There's faith in the future. Faith in the future is the only worldview, from an investor's point of view, that jives with the historical facts. It's the only one that does it. I mean, we live in an age of miracles, for Christ's sake. I mean, all this stuff is negative because of the press and everything. I mean, my family, my mother was born in 1911. Her life expectancy is in the 50s. My sister Peggy, 1943, she was born. Life expectancy is in the 60s. Sarah, my daughter, born in 1983. Her life expectancy is in like 86 or 87. Just my lifetime. People, live like 35 more years. These devices we're sitting on, all right, this computer I'm looking at had more computing power in it than the world had when I was born. It has more computing power than the thing that went to the moon the first time we brought the people up there. The vaccine in months instead of years. So that's the point. You have to begin to convince people that they're on their own, that they have to make some investments. And one of the great things I think about insurance products is the fact that they put some guarantees on it. In a variable annuity, I got an account balance. It grows no matter what happens. So you know what? The market goes down, I could care less. I'm not going to get out, and I don't get out. I got higher loads, but I didn't take the 57% haircut that you never recover from. And no one talks about that. So I think that's when people are being critical and they're looking at it. They think it's a math exercise. It's not. It's about human behavior, and only humans can do that. That's where I think, I'm glad we have robo-advisors and all of this other stuff. But an 800 number isn't going to say, no, you shouldn't get out of the bus market. Stay put, you jackass. It's not going to say that, right? It's not going to do that. So anyway, I know I go off on tangents, but anyway, next question.
So I wanted to sort of tie something that you were intimately involved in the past and sort of something similar going through now. You talked about how you had to convince brokers and insurance agents to kind of each do what the other did.
That's right.
And today the equivalent battle we have is with RIAs. RIAs and the use of a lot of insurance products. Right. So and it sounds like you're already having a lot of those conversations. I guess my question for you is, how long do you think it's going to take for that transition to happen, to where there's more openness, where there's less thinking exactly like Ken Fisher, and there's more sort of openness, and what are the steps we need to take to get there?
Well, I've found the way to change behavior, the way I did it at Payne Weber and Met, is I used what I call the lead steer theory. I would try to find just a few individuals and I would work it hard. So, Paul, were you around? No, that was there was a guy, Cold Call Cowboy, Steve Anderson. The guy was like 6'6", and he cold call. He was at the Payne Weber side. And we got him to start doing annuity business. And so we all got people, look, Steve Anderson's doing it. So I got a few people who were converts. And then what's beautiful about changing behavior of producers is they do all the work. So if he's doing it, someone else got to do that. So that's the point. Whereas before, people would go out and try to talk to the largest groups of people. No, I just want the top guys. And I want to find a few of them. And I want to infect the place. And so that's what I did at MetLife. I got a few infections, and then it started to grow. And then we found where the business began to grow was where you had some infected agent there, a lead steer who was infecting all of the other people. That's where you use analytics, for that purpose. RIAs and what have you, you bring it up. There's all this aversion to the idea of commissions. There's a lot of products that are beginning to come out of the insurance business that allow for a trail type of commission. So I think that's going to be there. But at the end of the day, whether you're fully commissioned or whether you operate, without commissions or what have you, people have the same problems. Okay, they have risks. They have a risk of dying. when they're in the middle of capital formation and do that. So an insurance company can take that away from you. They have a risk of becoming sick or disabled. That's an insurance company can do something about that. Then they have the risk of outliving their money, and that's the thing that annuities do. They just keep paying and paying and paying for the rest of your life. With those types of guarantees on top of that is something that so they should be taking a look at the merits of the product, where they have a tendency to say no. Now a big boogaboo that just went away was this Dalbar study. Said it actually performed better. It's the metrics you guys put up with. You say the fees are too high. It's about behavior, you schmuck, okay? Now, I believe that if you have a very competent advisor who has people in managed money, that person is telling people to stay put, and if they don't stay put, they get rid of them. They get people to follow what they do. So I believe that's the case. But the insurance products help to migrate that. And at the end of the day, it's it's how much you have, and it's all about income. I mean, it used to be about assets. That's the other fundamental thing. It was the whole idea that your wealth is predicated on the amount of assets you have is a recent phenomenon. I'll prove it to you. Jane Austen, right? She wrote these books in the early 1800s, Pride and Prejudice and all this other stuff like that, right? When she was explaining Mr. Darcy, the guy who had a lot of money, she didn't say he had £1 million. She said he got $10,000 a year. Historical perspective has always been on the reliability of the income. That's the new ROI, not return on investments, the reliability of the income. And that's what annuities provide. So people should break away the criticisms that they have and take a look at what they do.
It's interesting if you look at kind of the evolution of annuities in general. So going back to the 80s, it started off as fixed annuities that were being sold in the marketplace. Then the variable annuity comes into play with one crediting strategy within it, the S&P, and then you look at variables now, they've got countless sub-accounts in most of them. Then comes the FIA, just with an S&P strategy, and now you've got countless indices in there and bespoke indices. I guess, where do you see it going from here? I mean, there's been certainly an evolution process in the product line. Do you think it will go outside the scope of traditional investment insurance products into other products coming into the fold?
It could. I mean, I think we have a tendency to make things too complicated, and there's always a balance. Okay, there's three entities. There's a company, there's a producer, and there's a client. Okay, all three got to be a little sad. Just a little sad, because if the company's happy, if the producer's happy, you're paying too much for it. If the client's happy for it, it don't work. And if the company loves it, then you couldn't sell it if your life depended on it. So
we've seen a few of those products.
We've seen a few of those, right? So that's come out. So there's always has to be this balance, and so I think there's always. Look, I tend to be. Here's a fundamental thing: how one allocates between stocks and bonds is more important than the actual selection of those stocks and bonds. So I don't really care about the versus the S&P versus 6 or 7 other indexes. I mean, Paul will tell you I was a big advocate of indexes because it didn't matter where it was, because a lot of producers don't know where this money's going into and where they're doing it. So it's just the market versus something that's fixed. How one manages between stocks and bonds is there. But you do have some producers who take who understand the different indices and what have you, and they like to have complexity. But what happens is when you add on complexity, it's harder to explain it to people. So I think this is what. Here's another thing, okay? When you use this analogy when someone's new in the business, they come in dumb, okay? Then they get real smart. And after they're real smart, they get dumb again, because they got to be able to relate this to human beings. So I do think there tends to be sometimes an overkill. The other danger that you have in product development is the fact that sometimes you can take on liabilities that you're not there. It's an arms race. And then all of a sudden, now look, we lived through it, right? I mean, Paul, I didn't talk that much about it when it was there, but I knew that the VAs that we were operating with around the 2005, they didn't work, okay? There's no way in hell that 50 basis points mitigates stock market volatility. This ain't deep, okay? I did the research. I found out the stock market goes up and down. So sometimes it goes way down. And so what happened was, and then we had all of those death benefits. They were tacking on this thing, blah, 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 blah. And then the first time it hit was 2001 when the dot-com crash hit, or 2000, around that time, right? All of a sudden the market went down dramatically, and these death claims were real. It was real money that went out. 07, 09 was crazy. The products were underfunded, or they provided too much benefit. All from the standpoint of perhaps sitting there, and so I think that balances out. So you go through those cycles. So I think you'll see a lot of complexity, and that's there. I'm more interested. I just want more people in equities, and I like the idea of a protected equity type of investment strategy that turns into an income that doesn't turn off.
Yeah, what's the most important thing you think an advisor should be talking to their clients about in a period of uncertainty like today, Joe?
Well, I think one of the things you have to talk to them about is, first of all, you have to talk to them and ask them how they feel. And that's sometimes we always come up, we're looking for answers, and I think you have to ask the right questions. And that's one of the things in terms of the human relationship, which is let them talk about it. I think I'm going to run out of money and what have you. And so you let them dump their bucket, and so a lot of times we try to overpower them. See, that's kind of the issue from a sales perspective. And look, I was trained as a salesperson, so I'm not saying it's bad, but we would have a tendency to try to talk people out of stuff. You got to let them dump the bucket. And then you say, boy, so this is the disaster du jour. You see, you'll be out of money. You can't go to the dentist. You'll have teeth in your head. All of the scenario. Let them paint it. Then you say, I can. I really. So what you have to do is you gotta appreciate their point of view, and then you just say, I can really see why you're concerned about that. But how do you see this happening? And shut up. And then let them tell you.
So one of the things that has come up during the pandemic is just the way that advisors, have to work harder and differently to be in touch with their clients. And so I remember when you came on the show last, it was sort of earlier in this cycle, and you are the consummate people person, right? You like to go out and get in touch with folks. What can we learn from how you've adapted to this environment in terms of communicating with all the people that you talk to?
Well, I am a technology immigrant, man, and I hate this stuff. I mean, I hate it with a passion. I probably have a basement full of dead millennials who put this stuff together. This is my fans. I was resisting it so bad. I could breathe. I didn't do a webinar in my life until last April, and I had to do it. And I've done 130 of them. And so you know what I've come out and said is, this thing didn't happen to me, it happened for me. And the other thing that it does, it puts someone on the other end. I mean, that it doesn't work without people on the other end. I mean, I salute people who are trying to do Zoom calls and what have you, but people on the other end wouldn't do it. Now they are. So this is a whole nother world for us. So this isn't bad. It's half full, half empty type of approach. I just think this is remarkable, and we'll be able to operate a lot more efficiently, and also all of the impact it had on all of the bureaucracies. They had to adapt. They had to be able to do stuff and no wet signatures and all of the stuff we dealt with, Paul, right, at Met, in terms of the admin stuff that was necessary to do. So I would tell you this: I haven't met anyone, and I've spoken to a lot of people. There isn't anyone who would argue this. If someone was going to tell you on January of 2020 what was going to happen, people figured they'd be out of business. Just about everyone has said that they have done a lot better than they ever thought they would have. And then there's a consensus of people who said they've never done more, that this has been a big opening. So it's really the adaptability of people in this business and the industry that's really something people should be very happy with. So that's my thoughts on that.
Yeah. How about the industry itself? I mean, it's again, you say glass half empty, half full, and you see a lot of new owners coming and buying insurance companies. There's a lot of capital looking to enter the market. On the other hand, a lot of the big carriers are either selling their blocks of businesses, especially their VAs,
right,
or sort of sidelighting their annuity business. I mean, Are we going to see fewer players? Are we going to see different products? What do you think the next couple of years will bring?
Well, it looks like investment prowess is another major competitive edge, and especially with such low interest rates, And originally when the first indexed annuities came out, they were really, they weren't really all that good or consumer friendly. Of course, they've gotten a lot better, and now there's a lot of these structured products that have come out. One of the things about that is, when you measure inflation, I mean, I usually like to use a stamp. In 1991, a stamp cost 25 cents. And then the S&P was like $300, and now a stamp's 55 cents, up 2.5 times, and the S&P started out at 3,700, so it's 10 times. It's really big. But maybe you don't need 10 times. See, that's the whole thing. Is what happens is the investment is always talking about we can do a lot more. It's about performance. No, it's not. For somebody to just maintain their lifestyle, maybe 3% inflation or 2.5 times is enough. It reminds me of the story of two guys walking in the woods and there's a bear, right? And the bear starts running at him. One guy says, "We got to outrun the bear," and the other guy says, "No, we just have to outrun you." So the fact of the matter is that perhaps the bogey isn't as high. So a lot of these structured products come out, and it seems that you have to have a lot of investment prowess. So it's like BlackRock and all of these other guys that are getting in the midst of it, and they seem to be knowing what they're doing. And I guess if interest rates go up, and it looks like it's happening now, right? More traditional players will be able to play a more strategic role. But yeah, I mean, I think there's a lot of new types of and I like kind of the structured play because it deals with the way clients would look at it. And look, they have enough protections in it. We'll give you some upside, but we're not going to give it all to you. And we don't include dividends in it. And dividends become a really major part, of the performance. And we'll give you some downside protection too. And so people can kind of weigh that. So I think that's an interesting thing. So in a traditional sense, it's not going to outperform something else. But from that standpoint, it's better than what? What's the alternative? So I do think that investment prowess is becoming more important. I hope it's not back to Morley Thompson and all of those guys, back when, and Fred Carr. You see a bigger influx of investment-oriented organizations being able to take advantage of this current market conditions. Of course, something with 20 basis points can be all the difference in the world.
So, Joe, I guess going back to the agent and their perspective, and obviously the last year has put a lot of different ways of doing business out there in front. I've seen you do a lot of presentations about building your business, and you talked about at one point the DCC, the daily contact commitment. Can you expand on that a little bit?
Yeah, I mean, this is the thing that really, I have a saying, and I mean it. I said the business is built on two foundations: prospecting and everything else. and it's not a joke, it's real. I mean, the people who continually prospect, they're the ones who will stay in the business, and if you stop, you're dead. And the pressure that I felt in the business was, and everyone feels this, I have to get this done, there's so much to do. The beauty of the daily contact commitment is you make a commitment to call X number of people a day or see X number of people a day. And then when you do it, you're done. And so the difference on it is that you're managing to effort and not results. You don't control your results. You don't control whether someone sees you. You don't control whether someone buys from you. And you used to always say, I got a blank day, I got to do something. Well, that's when you turn into a maniac, It's just a question of continually doing that. And so when I had 10 no's, I had a successful day because I faced my fears, And sooner or later it comes into that because you have no idea. You're dealing with the human frailty of fear. It's almost like on the investment side, they forget all about the right side of the brain, the emotional side. Same thing in terms of the selling aspect of it. You have to set up, look, businesses are not run by people. Systems and processes run it, but people run the processes and the systems. So I always put forward the idea, and Nick Murray just came out with his updated version of the game of numbers, and it's just a question that if you continually prospect, you will will stay in the business. And I actually quotes my book in it too, so I throw that plug in. But the point is that that's what the business is all about, and that's why I think it's important that people feel good about what they do, because it's a tremendous amount of rejection, and you're not going to put up with that rejection if you don't think you do something good. And I think that's the thing that makes it happen. So I'm a firm believer in the idea of some form of daily contact commitment. I like to do it daily. People say, well, I do it every Wednesday. Yeah, but Wednesday, the Giant game is on and something happened, and you got a memo from compliance and you want to be compliant, and then there's another memo from marketing about Korean dry cleaners, and even though you don't have any in your neighborhood, and the next thing you know, is you go home and you miss it. So I think those are all of the mind games that are there, and I just solidly feel that if people recognize the fact that they deal with the major issue that humanity faces and go on that crusade, gives them the guts to do that.
Yeah, and I think what's so important about that process that you outlined is focusing on the efforts. I think we've become such a results-oriented, society that people can get discouraged, very early on. And I think if they're focusing, into your point, on what they're doing as daily activities, that'll get them through some of these challenging times.
That's right. Yeah, I agree.
Yeah, Ramsey, any other last question for Joe?
I think we covered just a ton of areas. Thank you for the history lesson, right? Thank you for your perspective on changing culture. I think that's really important, and also congratulations on setting a great benchmark for everybody and going from one way of doing business and being adaptable and making it work. So, lots of great intel for us today. Thank you for that.
No, thank you, Joe. Thanks for being part of our 100th episode. Let me ask you, so people want to get more of you, okay, Life of Significance, I know it's on Amazon.
No, it's not. It's not on Amazon.
Oh, it's not?
They don't know.
Okay.
It's in my website. It's josephjordan.com. It's pretty simple. The other thing I have, and you don't mind me throwing it in there, I'm also a big advocate for feminization of the business. I say that not because it's fair and it's the right thing to do and it's hip to say it. I think it solves a big problem. I mean, going forward, creating trust in relationships are important, and women do that instinctively. So we got to find ways to get more women in it. And of course, I grew up in a matriarchal home because my father died young, so I have more sensitivity to that. And the other thing is my book's in 5 languages, not just because I do stuff around the world. I think it's the changing face of America, and we should embrace it. So it's in Spanish, Chinese, Japanese, and Portuguese too. So I think that's something that's different. So it's josephjordan.com. Yeah.
That's great. josephjordan.com. We'll put it in the show notes. And Joe, I know we have a lot of people from carriers who are on here. I know you speak. Obviously, you've done 130 webinars this year. So hopefully, listen, if you like this, reach out to Joe and get him on your program. It's
I would just like to say I talk more about why than how, because there's a ton of how out there, and I really think we should. I think people will leave having a different opinion of what they do for a living, and to take advantage of this unique opportunity we have now.
Excellent. All right. Hey, Mark, Ramsey, thanks, Joe, and thanks for all the listeners. Appreciate your support and feedback for the last year and a half or so, and tune in again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.